morning. So, in the previous class we started the discussion on the Reserve Bank of India. In the first about the basic functions of Reserve Bank and as well as the major objectives of the Reserve Bank. And one of the major objectives of the Reserve Bank is the conduct of the monetary policy. Because as you know that there are three different major policies always we observe for functioning of the economic system. One is monetary policy, second one is fiscal policy, third one is the foreign exchange policy. So, this monetary policy is totally regulated and controlled by the central bank, and Indian context this is Reserve Bank of India, and the fiscal policy is controlled by the government itself, and the foreign exchange policy also is governed by the Reserve Bank of India. So, these are the three major policies always we see. So, today we will be discussing about different type of instruments what the central bank always uses for the conduct of the monetary policy. So, let us see that what are the basic objectives of the monetary policy in the actual sense. So, as you know the basic objective of monetary policy is to increase or accelerate the economic development in an environment of reasonable price stability. Because if you see that always that whenever we have measure two objectives, one is your price stability and another one is increase in the growth rate. But particularly in the country context we call it the GDP growth rate. But the price stability and GDP growth rate basically does not go together. Why? Because you see if we are changing the for example, we are changing the interest rate. So, if you are declining the interest rate, then what will happen? The money supply will increase because more banks can provide the loan or more demand for the loans will be there. The money supply will increase, then investment will increase. If investment will increase, then the output will increase. Then if output will increase, then obviously the growth rate of the GDP will increase. But at the same point of time, if your money supply is increasing, it will also increase the price level. It will also increase the price level. So, that means there will be inflation. So, this is a very tricky task for the Reserve Bank or the central bank, that whatever way the monetary policy can be implemented, by that both the price can be stable or the price stability can be maintained, and as well as the economic growth also should not be hampered. So, this is the major objective whatever we have in terms of the monetary policy. And second one is to develop the appropriate institutional setup to aid this process. And how this particular process will work? Because there is a channel which works in this particular context, and for the smooth operation of this particular channel, we need one appropriate institutional setup. And the Reserve Bank of India is responsible to see that in this context how the commercial banks are working, what is the effectiveness of this bank credit channel in this particular system, and all kinds of institutional setup always looked upon by the central bank for the smooth conduct of the monetary policy of that particular country. That is also another thing we have to keep in the mind. Then another objective of the monetary policy is to achieve the financial market stability, and again we are telling that the market should be stable. That means, you see in a general sense stability means basically what? Always we ensure that the market should be fluctuating, the market should be volatile. Why volatile? Because this is a desired concept. Unless the market is not volatile, maybe people will not be interested to invest in that particular system. But the volatility is required up to a particular level of a particular range. Let the volatility can be accepted to a particular range, but beyond that limit if the price is fluctuating or the market is fluctuating, then we can say the market is unstable. That means, too much volatility leads to instability. So, volatility is a desired concept, desired phenomena, but whenever the too much volatility we are talking about, that too much volatility is basically is a undesired concept or undesired phenomena. So, volatility is in a true sense is basically always we can ensure that is required, but whenever we talk about the instability, it is basically undesired. So, the one of the basic objective of the monetary policy is that they can control that particular volatility, by that the market can be stable. So, these are the major three objectives of the monetary policy in India. Then if you see the next is how the framework for the monetary policy in India basically works. Already I told you that the monetary policy is basically works in a particular system. There is a proper framework is existing for the conduct of the monetary policy. So, again we can go back to our discussion that whenever we talk about the policy, there are two debates. The basic instrument is we have to change the money supply. We have to change the money supply. If the money supply can increase or decrease, depending upon that, the investment, output, price stability, all these things basically get affected. So, the question here is whether the money supply is endogenous or it is exogenous. What do you mean by endogeneity and exogeneity? The endogeneity means basically that depends upon some other variables. If you want to change something, let that change is, or you want to find out that how this particular endogenous variable is determined, then that is y, then y should be a function of x. And here the x is basically what? The exogenous variable, which can be controlled by the regulator, but y, if you want to change y, then you have to change the x. So, therefore, the question here is whether the money supply is endogenous or it is exogenous. If you go by the economic theories, there is a debate that whether the money supply is endogenous or money supply is exogenous. So, according to Keynesian framework, money supply is exogenous. Whenever the regulator or the central bank wants, they can change that money supply on the basis of the requirement to control the price or to increase the growth rate. But the question here is, in a true sense, if you see, the money supply is not exactly exogenous or money supply cannot be exogenous. Then why this money supply cannot be exogenous? If you talk about in our country's context, that there are two factors which affect the money supply, but this is not in the control of the regulatory bodies like Reserve Bank of India. What are those factors? One is the inward remittances of the foreign exchange, how much foreign exchange is coming to India, the inflows, and the requirement of credit for financing the purchase of the food grains. But the requirement of the credit for financing the purchase of the food grains, that depends upon the various other external factors like monsoon, then the demand for that particular food grain, all these things. So, how much production will be there in that particular point of time, whether the particular country has to buy the extra product or the particular is the excess amount of the product which has been produced. So, there are different factors which are responsible for this. So, the RBI or the any central bank cannot decide that how much money is required to buy the product at that particular point of time, or how much loan can be given or should be given to procure that amount of the product, particularly food grains. So, this is not in the control of the central bank or the RBI, and another one is how much foreign exchange is coming to India in that particular period. And but those two variables have the impact on the money supply. So, in a practical sense, the money supply cannot be exogenous, at least for the Indian context, because the total money supply cannot be controlled by the regulator. So, if the money supply cannot be directly controlled by the regulator or cannot be changed by the regulator, then what basically we are thinking of? We are thinking of a framework, and how that particular framework looks like. If you see this framework, we have a framework like this. We have to change certain instruments. There are certain instruments has to be used to change the money supply. So, these instruments will have the impact on the money supply, and here the money supply is the intermediary targets or intermediate targets, money supply or bank credit. These are the two variables which are the intermediate variables in our context. Then finally, if the money supply gets changed and the bank credit gets changed, or the bank credit means the amount of loans what the banks are giving, if those things will change, this will have the impact upon the investment and finally the output. So, this is the way the channel works. So, that is basically we call the monetary policy framework. So, then the question here is that intermediate target is money supply and the bank credit, and final outcome variable is the either price stability or the output. And the question here is what is the instruments which can affect this money supply and as well as the bank credit. So, these are basically we call it the monetary policy instruments. So, our basic discussion is basically to try to identify which are those instruments the commercial banks or the reserve bank always uses to change the money supply or the bank credit, and finally, the output variables like your price stability or inflation and the GDP growth rate get affected. So, let us see that what are those instruments basically we use as the monetary policy instruments for India. So, there are many instruments we have. Over the years, the Reserve Bank of India is using as the instruments for the monetary policy. The first instrument which is very popular in the market, that is called the open market operations. What basically the open market operation is? The open market operation in a actual sense is nothing but it is the buying or selling of the government securities to adjust the liquidity conditions in the market. What does it mean? If for example, the money supply is high, already the money supply is very high in the market or liquidity is very high in the market. If the liquidity is very high in the market, then what this Reserve Bank of India can do? The Reserve Bank of India can sell the securities, sell the government securities or government dated securities. So, if they sell the government securities, what they can do? They will suck out the money which is available to the public to them. Against that, they will provide these bonds or government securities, and money will be basically going to the Reserve Bank of India. So, the total circulation or total availability of the money in the economy will go down. Circulation or the availability of money with the public. Then obviously, what will happen? It will basically reduce the money supply and the other channel will work accordingly. The reverse can work whenever there is a illiquidity or the money supply or the liquidity condition in the market is very low or there is illiquidity in the market, then what Reserve Bank of India can do? Reserve Bank of India will buy the securities from the public or from the market. So, if they will buy the securities from the market, then what will happen? They will pay them, and against that the bond whatever this banks and other market participants are holding, they will take that bonds with them, then more money will be coming into the market and therefore, the money supply or the liquidity of the market can go up. So, the open market operation is nothing but buying and selling of the government securities to create the liquidity or to inject the liquidity or to absorb the liquidity from the market. This is one of the instrument which is used by RBI to change the money supply in the economy. Then another one is bank rate. By changing the bank rate also, which was popularly used before, nowadays it is not a very popular instrument which is used to control the money supply, but in 90s it was used as an popular instrument as the popular monetary policy instrument to control the money supply. What is the bank rate? The bank rate is basically a rate at which the commercial banks can borrow from the Reserve Bank of India. But the bank rate is relatively a long term rate. The bank rate does not change frequently. So, the bank rate is basically a long term rate, but this is the rate at which the central bank allows finance to the commercial banks, or in otherwise the commercial banks can borrow from the central bank. So, if the bank rate will increase, then the availability of the money supply will go down, because the bank rate will increase, then the market lending rate will increase. If the market lending rate will increase, then the demand for money will go down, then availability of the money to the public or to the market also will go down, then the money supply will go down, and the reverse thing can happen whenever the bank rate will be less or bank rate will be low. So, these are two instruments. Then the other instruments are, if you see that another one instrument is the cash reserve ratio, which is again and again used by the Reserve Bank of India to control the money supply. What is the cash reserve ratio? Cash reserve ratio is nothing but it is a cash which banks have to maintain with RBI as a certain percentage of their demand and time liabilities. Here, if you remember, what do we mean by this demand and time liabilities? It is nothing but the deposits, your saving deposits or the savings or the time deposits or the fixed deposits. So, certain percentage of the total deposit has to be kept with the RBI as the reserve. It is 6%, 7%, it varies on the basis of the liquidity condition in the market. And here, if your CRR is increasing, then availability of the money to the bank will go down, then obviously your money supply will go down. If CRR will be less or will decline, then money available to the bank will go up, then money supply will go up. So, this is the way, by changing the cash reserve ratio, the commercial the Reserve Bank of India also can control the money supply. Then another one is your statutory liquidity ratio, which is popularly known as the SLR. What does it mean? According to the RBI regulations, there is a mandatory percentage of the total deposits what the commercial banks have to invest in the government bonds and other approved securities, mostly the securities which are highly liquid, The highly liquid instruments has to be invested in the highly liquid instruments, this particular money should be invested. A certain percentage of the money should be invested in the government securities or highly liquid bonds. But the question here is, why it is so? It is so basically to restrict the expansion of the bank credit, because the commercial banks may not be free to use their funds in whatever sector they want to use it. To increase the banks or to augment the banks investment in the government securities, and to ensure the solvency of the banks, which is very important. What does it mean? The solvency of the banks means, once the some amount of the money, stipulated amount of the money is invested in the government securities, then if there is any kind of crisis or any kind of instability probability is there, then what will happen, that because those kind of instruments are risk free, more or less there is a perfect kind of guarantor for that, because this is guaranteed by the government. So, in that context what will happen, the bank can basically get out of that any kind of liquidation or the insolvency. So, that is one kind of security what the bank always should have if they have invested some funds in the government securities, and as well as it also controls the money supply. So, this is the basic objective of having the SLR instruments or SLR kind of instrument for conduct of the monetary policy. Then which are those other instruments? These other instruments are the direct credit allocation and the credit. You see, the Reserve Bank of India also control the distribution of allocation of the credit among different sectors. There are some priority sector, some amount of loans should be given to the priority sector, and there are some sectors where there is very highly risky sectors. Those sectors also, the loans given to those sectors also should be controlled. That is basically this guidelines what the Reserve Bank of India has given. So, by controlling this, what they can do? They can, that is why for this they basically go for a fixation of specific and direct quantitative credit ceiling and credit targets. They have given the limit that how much loans can be given to that particular sector or particular company or particular individual, and as well as which are the sectors also should get some loan like the priority sector, like agricultural sector on and this small scale industries and etc. Which restrict the drawing power of the borrowers under the cash credit limits. Certain prescribed credit deposit ratio also already given in respect of their rural and semi-urban branches separately. That means, the 60% credit deposit ratio should be there. Credit to deposit ratio should be at least 60%, and that credit deposit ratio can vary across the regions. Some of the banks may be in the rural areas, some of the banks in the urban areas. So, depending upon the credit worthiness of the customers or the individuals or the different kind of borrowers, the Reserve Bank of India has fixed this credit deposit ratio for the different type of customers. So, this is what basically the one of the instrument through which they can control the money supply in the system. Then we have another instrument, we have selective credit control. Why basically the selective credit control is there? Because they are used to reduce supply of credit in certain directions and to encourage it in desired directions. Why? Basic objective of selective credit control is to stop the hoarding. So, what is basically happening at the time of low price, sometimes what has been observed, some of the producers can hoard that particular product by taking more loans from the banks, and in the future period they can sell it at a higher price. So, RBI basically is ensuring to maintain the price stability. What basically RBI does, what the central bank does, they can regulate, they can control that particular entity or particular sector in terms of the providing the loans. So, if the loans can be restricted, automatically it can discourage the hoardings, and as well as the price fluctuations also can be controlled through that. So, the selective credit control is also a very quite old measure, and this we are using it, or RBI also use it as one of the monetary policy instruments whenever there is required. Then what are those other instruments? The other instruments are like we have the credit authorization scheme. Here under this scheme, what basically happened, the credit proposals for rupees 5 crore and above in the case of working capital and 2 crore and above in the case of term loans had to be submitted to the RBI for the post sanction scrutiny. Because every companies need the working capital finance. If the working capital finance means day to day finance, if they want from the commercial bank, and if the amount of money is going below the 5 crore, they need the prior approval from RBI. The bank should take the approval from RBI. This is number 1. And number 2, if it is an individual entity who taking the loan more than 2 crore, then what is happening? For that also the prior approval is taken from RBI, and through that process RBI tries to control that what kind of customer is taking the loan and for what purpose the loan is given. It has two objectives. One is to control the non-performing asset in the system, and as well as to control the amount of money supply to the system at a particular point of time. So, that is basically it is defined as the credit authorization scheme. Under that we have credit monetary arrangements through which this particular mechanism works. Then we have a process of credit planning. What do you mean by the process of credit planning? You see, each bank is required to prepare a realistic annual credit budget, incorporating estimates of the volume and growth of deposits and other resources and the demand for credit. That means, RBI has given the kind of information or given certain kind of notification to all the commercial banks to prepare the budget for their credit allocation, and as well as that what kind of deposits they are expecting in that particular year. A forecasted figure of the real increase of the deposits or the expected demand for the credit, that thing all those details has to be prepared from the beginning, and once the proposal is ready, it is subject to change, but at least the proposal from the beginning should be ready, and proper planning has to be done to ensure that the money supply in the system at a particular point of time can be controlled. So, in this context, if there is a proper planning which exists, then that can go to RBI, and RBI is ensuring that this is the way the money supply is going to be there in the next period. Then moral suasion means what? It is basically writing letters, holding discussions between RBI and the banks about the trend in the economy in general, and money, credit and finance in particular, about the measures which ought to be taken from time to time in light of the different objectives, and the objectives are basically nothing but the price stability and the increase in the growth rate. So, this is basically informal kind of way of controlling the money supply, because if any commercial bank, if RBI feels that the bank needs advice or they should understand what is the economic scenario and what kind of demand should be there for the credit, and as well as whatever amount of deposits should be there in that particular system or that particular point of time. So, depending upon the economic conditions, what basically the RBI and banks decide that how much loan can be given in that particular point of time. So, because of that, the moral suasion is one of the instrument which also can be used. Then the most important instrument which is basically done by RBI in today's context, that is called the LAF, liquidity adjustment facility. You have already aware about the reverse repo rate, repo rate. So, these are the different rates which are used under this LAF or the liquidity adjustment facility, and it is basically manages the liquidity on a day to day basis. So, the operations of LAF is conducted by way of repurchase agreements, repo and reverse repo, with RBI being the counterparty for all the transactions. What basically happens? Repo contract is basically an instrument for borrowing funds by selling securities with an agreement to repurchase the said securities on a mutually agreed future date at an agreed price, which includes interest rate for the funds borrowed. That means, the commercial bank will borrow from RBI. Here, the commercial bank will borrow from RBI with an agreement that the security can be repurchased further with an interest rate. And the reverse repo rate is, which is the lending of funds against buying of securities with an agreement to resell the said securities on a mutually agreed future date at an agreed price, which includes the interest of the funds lent. It is reverse. This repo rate is charged by RBI and the reverse repo rate is basically charged by the commercial bank. So, if the commercial bank wants to borrow the money for overnight basis from RBI, they want to borrow at a repo rate with agreement that the money can be again given back to the RBI, and again if there is an excess kind of money which is available with the commercial banks, then RBI can take out that money from commercial bank, it can be parked in RBI and that is basically rate. For that RBI pays some interest to the commercial bank, that is basically the reverse repo rate. And the reverse repo rate and repo rate both are basically always changed from time to time by the Reserve Bank of India. So, using this repo rate and reverse repo rate, a monetary policy operating procedure has been established. In the current context, if you see, the RBI wants there should be a corridor. So, this total one is basically your corridor. So, here in the corridor they have a single policy rate, that is the repo rate, and in the below, which is the floor, that is the reverse repo rate, and in the above they have a marginal standing facility rate. What basically happens, and here if the repo rate is x, your marginal standing facility rate is x plus 0.25% and a reverse repo rate is x minus 0.25%. So, that means the total corridor is 0.5% or the 50 basis point. So, what is the objective? And the target rate is the call money rate. The mechanism works like this: if repo changes, repo increases. So, it will change basically the call money rate. Call money rate means the interbank lending rate. It will have the impact upon the call money rate. So, if the call money rate change, we can define it in this way: if repo will have the impact upon call money rate, if call money rate changes, then the market interest rate or the lending rate changes, then obviously your investment and output also gets changed. So, that means the RBI always ensures that the call money rate should be below the marginal standing facility rate. What is the marginal standing facility rate? The marginal standing facility rate is little bit more than the repo rate. So, if RBI wants to borrow, wants to lend more money to the commercial bank, or commercial bank wants to borrow more money from RBI, so they can borrow at a MSF rate after their limit is over in terms of repo rate. So, then at that particular point of time, RBI ensure that instead of going to RBI, they should go to the call money market. Call money market means one bank can borrow from another market, another bank. So, that what is happening, the total amount of the money supply will not get changed. So, the RBI's target is maintained if the overnight call rate or the call money rate is below the marginal standing facility rate. That means, whatever target RBI has made, that particular target can be maintained over the period of time. So, if on any point of time the marginal standing facility rate will be cheaper than the call money rate, then the commercial banks will prefer to borrow from RBI. Once the money is coming from RBI, it will affect the total money supply, then automatically it will affect the price stability and other issues. So, that is why RBI always ensures that this corridor should be maintained, and once the corridor is maintained, then whatever forecasting and the planning has been made in terms of the price stability and growth rate, that will not going to be affected in that particular period of time. So, this is called the operating procedure of the monetary policy, but there are certain challenges, there are certain revisions which have been made in terms of the monetary policy that we will be discussing in the next class. This is what basically we are discussing today. Next class we will be talking about the challenges and as well as the autonomy of the Reserve Bank. Please go through this particular references for this particular session. Thank you.